Good morning, everyone. This is Greg Dixon from Shared Visions Unlimited, and you're at the investing show. And today we're going to talk about hypothecation. And I had a joke that came to mind. Uh, you know, um, what was that? You have to take the hypothecation oath or something like that. The medical terms. So it's a little bit confusing. But my layman's and this understanding of this is somebody has some kind of investment project and they're looking for private money in order to fund it. For example, we have somebody who wants to buy a big condo project in say Dallas, and then they're looking for money to invest it. And the hypothecation is a way is kind of like the promissory note thing in order to get more than one investor to go in without worrying about whether the the contractors are going to show up and all that kind of things. So I think, Alden, you have a more technical explanation of what this is. Do you want to just run that by us again?
Yeah, so hypothecation means to pledge an asset in order to garnish capital investment. So opposed to, securitizing an asset or selling partials or investing in a fund, an investor can get the asset of, say, a note, and they participate in the success of that note in an agreed upon rate while not having to own the entire asset. They lent to a qualified operator, getting their collateral in exchange, right, and an agreed upon return. So that's kind of the vehicle of hypothecation. It aligns qualified operators and lenders who want, say, an annualized term, and they can have potential for liquidity at the end of the contract, whereas the operator still owns the asset, if that makes sense in layman's terms. So that's just a quick little explanation, case specific to notes.
Yeah, okay. So Rodney's joined the conversation here. I just got to say we've got an international broadcast here today. So I'm in Canada, and Rodney and Alden are in different parts of the U.S., and Khaled is in Dubai. And so one of the things is Khaled was not sure if how this hypothecation would apply to what he's doing in Dubai. I'm gonna speculate. Let's say there's a group of investors in the U.S. wanted to invest in a project in Dubai. I think the hypothecation is how, from the private lender's point of view, that's how that would look like in order to get into the investment. Maybe we can talk about that. Is that the kind of question you had in mind, Khaled?
Yeah, yes, because we are not familiar with the term here. The ecosystem and the culture here, we usually deal with banks. Yes, we are familiar with the capital funds. We are familiar with private investors, but this term is new for us. And I want to ask if let's say one investor here or developer want to seek one of the companies from US to buy a note or something, or the opposite. Is this is there a possibility for that? How it works? We'll seek opportunities here. Yeah.
So essentially, I seller finance and originate promissory notes, right? On housing by first lien position, creating almost like a mortgage, right? So that mortgage I can pledge as an asset to get investment. That investor, one investor on one loan, right, outside of the agreed upon mortgage for the end user. So let me back up here. The mortgage has a term of 20 years, right?
Yes.
When you're
Yes.
paying on a loan, it's normally
Yeah.
amortized over 20 to 30 years at an agreed upon rate with the end user borrower. That borrower could be paying as low as what Fannie Mae and Freddie could be giving a loan for, say at 6.5% as a first time home buyer. Not a high return on investment, but that's a bank's position. Or in the secondary market, they pay higher rates. So in secondary markets, they could be paying as high as, say, 20%, depending on the state that those mortgages are being originated in, because every state has different laws that attribute to what a usurious rate would be. Here in Arizona, unless otherwise agreed upon, so as long as it's agreed in writing, the rate is considered non-usurious. We sell or finance our positions at 14 and 15% over 30 years. For an investor internationally, not everyone wants to own a note, say, for 30 years. That's a long time position. They may want potential liquidity in 1, 3, or 5 years, kind of benchmarks for people that are wanting options at that time. The bridge between the loan, the operator, right, who procured the asset out on the market, and a pro forma note can now pledge that note at an agreed upon term to a new private lender who was looking for either a collateralized lending opportunity and want to control a single asset, or really looking for an above average return outside of pressurized residential real estate long-term rental strategies that yield very low. In exchange, they can alter their strategy into hypothecation. They align themselves with a qualified operator who's procuring higher than average return on investment notes and participate on an agreed upon term on this one note, one investor, and they cash flow together. So potentials for an investor, say internationally, who had $100,000, say I had, hypothetically, right? Say I had a note that was consummating, and I'll just run that on a mortgage calculator real quick. We'll go through this real quick. Say that home was for sale at $125,000. The investor's not wanting to own that home. They want payments and collateral, right? So how do we get to that? I sell a house for $125,000. They put, say, $25,000 down. The unpaid balance or loan, the investment, right? The loan is $100,000. The loan's paying 14% for a 20-year term, and that monthly payment is $1,243 a month. And in this situation, there's no banks. So we're the bank, right? Participating, creating a loan, getting the buyer underwritten, Dodd-Frank compliant, and a lien position secured, first lien and only lien on the property, right? That loan being the investment. As we pledge that note, the investor doesn't want a 20-year term. They may not be a note investor or understand the potential exit of cross-leveraging that with other investor capital. They want a 1, 3, or 5-year term at a negotiated rate at less than what the note yields. I look for capital to pair up to that position at the unpaid balance, say of $100,000, and I garnish that capital at less than what the note is yielding because of my expertise within note education and investment strategy, etc. So what does that look like? Say $100,000 on the investor's side at a monthly payment for a 1-year term could be $833.33. I'm arbitraging a monthly payment of $1,243 from the borrower, right? The borrower's paying $1,243, and I'm paying my investor $833.33 passive, right? So a performing piece of collateral, an agreed upon term from the borrower. I seek capital for less than what the yield of the note is. I pledge that note so they get collateral in exchange for their investment. They're buying this position for an agreed upon term. Say it was 1 year paying $833.33. What happens in a year from now, or what happens if someone goes non-performing? That's the risk within the strategy, which is mitigated with underwriting. But as we do ample amount of transactions, there's people bound to default. What does that look like? And in a year from now, is there potential for liquidity? So upon the expiration of the contract, depending on the term, a 1, 3, or 5-year term, they could get a higher rate of return in monthly payment going at a longer term. But with their collateral in a year from now, I say, hey, congratulations, you've received your monthly payments. In this case, the buyer borrower is actually still performing. So would you like to liquidate that $100,000 position and you go take your daughter to college or have a great birthday or whatever it may be? $100,000 birthday may be a little extravagant. But at that point, they have a call for liquidity. Hey, do you want your money back, or do you want to auto rollover? Because this note actually happens to be continually performing, right? What is the latter? What happens if someone goes non-performing in a hypothecated position? The operator, at no cost to the investor in most cases, will re-perform that note or home. They'll go through either a foreclosure processes, or in manufactured housing, it's actually repossession. And the objective is to recapture potential additional profit upon non-performance of the note and continue paying the investor their hypothecated loan, because really the operator took a loan against their position. So they're held to the monthly payment depending on what the agreement says. Maybe it goes deferred at that time for them to accrue interest over that period of exit upon getting the home restabilized and remarketed out on the regular market here in the nation, in this specific. But that being said, it's a passive strategy for capital to align with operators and have subject risk. They don't own the operation, right? They're giving a loan with performing collateral, this case being notes, which is a bank's position, collateralized lending, pledging the note from a qualified operator to a passive lender that wants liquidity, 1, 3, or 5 years. What's the validity of providing liquidity within that transaction for the operator? If I, as an investor, come into the position, say with $50 million, what's the likelihood of me being able to exit, say 10% of that within a reasonable amount of time outside of a miracle happening? There's secondary markets actually for debt, for performing debt, subject to the monthly payments. Are they paying on time, and what's the condition of the home and the collateral file? So the buyer borrower's file that they go through underwriting, is that a complete file, etc. So those are all subject conditions to provide liquidity to the investment capital that comes on one note with one investor, and we have been cash flowing. So that's kind of a little light synopsis of how, say, an international investor who may not want to invest in a fund, or they want to touch, feel, and taste the investment strategy outside of just investing in someone's fund. People are cautious with capital. It's important to be risk mitigated and do due diligence in order to facilitate a risk mitigated investment. And some of that is part of investing via hypothecation, especially for us at Mobile Mailbox Money and Silvercrest Opportunity Fund. That's how we establish trust. People buy either a hypothecated note or a whole note, right? And they touch the monthly payments distributed through automatic funds transfer services. And at that point, they get more comfortable. They have more insight into the mechanics of owning a note or lending via hypothecation, kind of entry level for a lot of individuals wanting to participate in notes, but they're actually not a note investor. Maybe they just have 20 to 100,000 in an IRA, or they have, a couple $1 million liquid in a money market account because of non-stability going on in the stock market, with silver and gold, seeing crazy sways, that volatility can really have people start to lose their hair at the end of the day. So that's kind of just a little synopsis of hypothecation and why and where's the opportunity.
So thank you for that. So Rodney or anybody, do you have a question, Rodney?
I'd just like to give it from a different perspective. I'm a individual investor, and from my mentor, Desi Arnaz with the Note Investor University, he always said to us that if you want to make money, yes, you can go out and purchase notes for your own portfolio, but the real money comes when you can invest using OPM, other people's money. And when you do that, your return, of course, is 1,000% better. And so when you invest as a private investor, you can only go but so far. Your funds will run out. So therefore, you either look for a partner, but when you use partners, you give a percentage. You give them a percentage of the you give away a percentage of the income, and then when the profit comes, you divide that on whatever split you negotiate. So you give up a little bit more. But if you negotiate a private lender investment into your deal, or better term, hypothecation partner, you're only given that interest up. And that's what I do. I try to hypothecate using that investment vehicle to give them a certain percentage of what they're investing. And that way, I don't have to share. It might sound greedy, but I don't have to share the potential profit should anything be a windfall or maybe even a deficit. You keep all of you are responsible for the outcome at the end. And so hypothecation is an opportunity to gain by using other people's money. So, and again, it's just another word for a private lender. I don't know how that term actually came into play, but hypothecation is what a private lender is to your deal.
Yeah, thanks, Rodney. The other thing, going back to what Desi Arnaz would say, is if you have private lenders on a deal and the underlying thing, say, Alden mentioned you might have to go execute foreclosure or something if the borrower is defaulting. But Desi always said your private lenders don't have to know that. You make them whole, even if from the deal from your side has some challenges. So they have some stories where it might take 2 years for them to recover from something going south. But that's a small percentage of what everything they're doing. But things can go wrong.
Right. And you want to, you want to, excuse me, Greg. Yeah, and you want to shield your private lenders or your hypothecation partners from anything else that's working in the background, because they trust you to use your expertise, your connections within the industry to just provide them with their steady cash flow for whatever the term may be.
And really, for other people in notes, that's really eye-opening, because it provides them the availability now to actually go and raise other capital, for the notes that they may have built up their own note investment portfolio, or their strategic, like Rodney, who's leveraged his education with the Note Investor University to go start raising capital for notes. It's power in the hands of the operator. You now get the power to go leverage your positions, opposed to having to start a fund. That can get expensive, or selling partials. It's a larger level equation, because you're taking one investor on one note and pledging its leverage against that position. So for the people in note investments, there's a real opportunity, because why people are looking for collateralized loans, collateralized lending, as well as a monthly income oriented investment strategy. Where in the nation can you find a double-digit yield outside of the stock market and monthly income from a performing asset that's not, a new build multifamily complex that has challenge? It's one door at the end of the day. So kind of eye-opening for a lot of people that may have been around notes and have yet to take that leap, starting to hypothecate even their own positions. So yeah.
So yeah, that's a good way to say it. There we
Nice.
go. So
I have a question. Sorry,
Okay.
Greg. Yeah, what is the maximum risk for a note investor? What is his risks? Let's say I want to invest in a note, okay, through your company or something. What is the maximum risk that I will hold for, let's say, 1 year, 2 years, depending on the period for the note?
So,
Go ahead.
yeah. The risk is in the underwriting, the loan to value, and the position being recorded. So contingent on the buyer borrowers, let's say that's a primary homeowner occupant. Did they go through underwriting? What kind of criteria did they facilitate? In our position, we originate and require them to qualify with a 600 plus credit score or ITIN number, no past criminal, no open bankruptcies, no past evictions, and verifiable income. And then in addition to that, they go through another secondary underwriting to qualify for the loan. So they prove they're an upstanding citizen on one hand, and also additionally get financially underwritten for a debt to income ratio similar to FHA, and put their down payment towards the balance. So they go through a stringent criteria to get underwritten to get the loan, right? That's risk mitigating your investment at the end of the day. That's number one. So did the buyer borrower get underwritten? Number two is the lien recording actually on title, and how much down payment did the buyer borrower give? In our case, since they're getting double underwritten, we'll take in most cases a 10% down payment. So it's about a 90% loan to value, which is a little bit higher, but the buyer's getting actually qualified twice to facilitate the transaction. Number four is the potential for default. What's the likelihood that this property is going to go non-performing, and is there potential for either loss or additional return on investment within that transaction? Within the underwriting, it facilitates our default rate of about a 2% default rate. So out of every 100 that we do a transaction on, we have about 2 that either go non-performing and get repossessed, evicted, or foreclosed, in other words. In those cases, we do our best to throw either a payment on the back of the loan, so we'll modify that transaction to still continue performing that asset. We'll go and either a couple other ways in order to continue earning payments on that transaction, or we repossess the home. And once that repossession or foreclosure takes place, that investor's still getting paid in the within the terms of the agreement throughout that time. So as Greg and Rodney had mentioned, you're not obligated to tell the investor that the home went non-performing, because you're reperforming the asset outside of their needs of, hey, what paint color are we using? what do we need to redo the AC unit? You're the lender, so you lent on the asset, mitigated by the loan to value, the underwriting of the buyer borrower, and the expertise of the operator that you lent against their asset. Due diligence is important at the end of the day to find the right operator. There's a lot of gurus online that, teach a lot of note investments as well as subject twos and things of that nature. In all areas of investment, it's important to do your due diligence to make sure you're moving forward with someone who is qualified.
Yeah. So, and I'll pick right there from Alden. Yes, due diligence is the key factor in investing in notes. You want to make sure that look at the borrower's pay history, and you you want to make sure the property has clear title. Your due diligence is the key point, and that's where if you're buying an individual note, you want to make sure that that's how you work in your profit margin. Should you see anything wrong with the paperwork, because remember, we're buying the paper. So if you find something not to your standards in purchasing a note, that's your negotiating piece to say, well, I'll pay this amount because I found this in my due diligence. And the other part is, what did I have? God, I can't think about it right now. But due diligence is key, and you work in it. Most of the time, with any type of real estate deal, your profit is made on the purchase or how you purchase the property. You get that discount up front. With mailbox mobile mailbox money, you're buying at par. So you're buying with the potential of that higher yield in the interest that you're getting from them, and you bank on that. So, but other than the other risks that I can see, really, that's why I love notes. There's not a lot of risk, and if they are, they increase in your favor on the back end. If they pay off your loan early, your return is greater. If you have to foreclose, 9 times out of 10, you take the property back, and whatever period of time that you've owned the property, I'm assuming that it's appreciated in value. So you're taking back the collateral because and you're buying, or you can sell at whatever the market rate will bear on the foreclosed side. So it's, to me, I don't want to. It's almost recession proof. It's just, it benefits you exponentially should anything go wrong.
Yeah, I think Desi and Patrick have examples where sometimes there's more money to be made when something goes wrong. So,
Absolutely.
yeah.
Yes.
So the other thing is, Alden, you have the Silvercrest investment fund, and then you also deal with notes. So what is the difference? Let's say an investor investing in the Silvercrest investment fund, do they need to know what the money is used for, or how does that work?
So upon review of the private placement memorandum, that will explain a little bit further about where the capital is being deployed. As a 506c accredited investment fund, we operate in notes. We're a debt fund currently operating in credit strategies as seen before you on mobilemailboxmoney.com. We buy our notes that we originate, and our notes yield higher than traditional real estate investment strategies. So our availability to provide a income-oriented investment strategy with not having to do formal checks and balances on individual notes, which can get time consuming. Not everyone has the expertise, know-how, or the time to do multiple evaluations of, say, a portfolio of 10, 20 notes. Really, they have $5 million and they want a return, and they like the strategy. They like the note investment strategy, for one, because it's an income oriented investment, but also it's the lowest risk position in a capital stack in any real estate investment strategy. But also they can become a per unit owner share in multiple notes. So within a portfolio, opposed to hypothecation, which is one note, one investor, and they cash flow together. As president and manager of the fund, I offer per unit owner share in our debt portfolio, where we provide, say, a 10% return for a 1-year term paid monthly, a 12% return for a 3-year term paid quarterly, or a 14% return for a 5-year term paid monthly, where we absorb notes into the fund and we cash flow across the strength of the diversified positions we have in $30,000 to $150,000. And right now there's about 20 to 25 positions that are all performing within the portfolio, which provides additional safety, security, and a bank's position. So bank level investment, opposed to putting your money literally in the bank making 4%, you're doubling or even tripling your net return annualized, and across the stability of 20 affordable double-digit yielding assets happen to be in the Arizona market right now.
And Cal, I forgot about 2 other risks that come.
Go ahead,
forward.
please.
Huh?
Go ahead, please.
Okay. And these come up mainly throughout your time of ownership of a note. It's paying the taxes and insurance. You don't want to have the taxes lap, because you can have, there's a whole nother industry of investors in real estate is buying the tax positions in these properties. So you want to make sure that the taxes are paid, and of course insurance. You want the borrower to keep their insurance on the property. If not, you put forced place insurance on it yourself. And this insurance is not for the borrower, it's for you as the investor. And you don't want to have the property burned down and you don't have any type of insurance on it. So those are two risks that you have throughout your ownership of that note. So
Fair enough. Yes.
So for the people that don't, want to learn those checks and balances, and a lot of people don't realize there is management to a note. There's an element of checking taxes and insurance every year to make sure that your position is covered, that payments are coming on as agreed upon, that the servicer is actually doing what the servicer should be doing at the end of the day. That's where the rubber meets the road for, say, someone like Khaled in Dubai, who really just wants to passively lend through either hypothecation or buy a note. That's a wide door of opportunity, and how to even facilitate that transaction. Say, just let's get case specific to an international investment. You can't just send a $5 million wire across the border. The banks will hold that up, and you'll create a lot of challenge. I've heard of great vehicle being cryptocurrency. So, to bridge that gap internationally for people that even may be watching here today, using crypto, not for ownership of a transaction, but really just providing liquidity to the agreement. It's a great asset to have in our back pocket as we have, further outreach into international waters. And obviously we're, going to do our due diligence of everyone that we're taking capital from. But that's truly eye-opening, I think, for a lot of people on how to actually capitalize on opportunities that are even seen at mobilemailboxmoney.com or in the fund, or with Rodney Madison here today. So, kind of subtopic, but great to discuss.
So Khaled is in Dubai, and I think one of the things is you use different terms and different ways. So I was wondering if we could do some brainstorming. Maybe you could explain what real estate investing looks like in Dubai, and maybe we can discuss how, say, a group of people in North America could pool together and invest in a property development in Dubai. Do you want to? You want a game to play the game?
Yes, yeah. It's my cup of tea, and it's okay, sure. The idea here for the big sharks, they usually get JVs with the top developers. So let's say they invest directly with the developer and enter to a joint venture contract to build a project. And usually properties here will be sold before completion. So during the construction phase, people will start buying the property into an installments. So there's a profit will be divided between the developer and between the investors. This is in generally how they do investments. The developer must own the land and must have the 20% cash of the project budget to build, and then he can, or the owner of the project, he can launch the project and start accepting money from the end users or the buyers. And by the time he will start paying the construction wise. This is in general how it goes. Some project has gone at the day of the announcement of the project. Many projects sold out on the launch date, and more than 300, 400 units in less than an hour sold out for specific developers here. There's an aggressive demand worldwide to invest in real estate, not only for the purpose of moving in, but also for the purpose of the capital appreciation that they are getting. It's the average here is around 10%, especially for the ready units or the units under construction. This is in summary how it goes. Yes, the fund or the notes, it's an opportunity actually to link it with the developers, with the real estate, with the small developers to become, let's say, bigger, to start having more opportunities, to be able to buy more lands, to develop.
Okay. Do you have any questions?
Yeah, I was going to, Kelly, I remember you talking about this with Dr. Ivan, but if you can, please refresh my memory.
Go ahead.
What's for a smaller scale of an investment there in Dubai? What is the potential investment amount for one of the smaller deals?
A smaller as individual or as
Give an example of both, as a small one, single investor, and then maybe a group.
I think perhaps like a single unit rather than a larger multi-family thing, a smaller, maybe like a house or.
The idea here, the bigger is the much better for let's say income. And here the studios, the there's I don't know if you are familiar with the studios term. It's not it's like a hotel apartment, but it's around 200,000 US dollar.
Okay.
This is the smallest, okay, that you can invest in. You can buy by paying only 20% now and divide the remaining during 3 years, let's say till completion. So this is the smallest, but don't expect to have a high appreciation or capital appreciation on the small units like this, because this kind of investment, and most of the people they are buying studios because it's affordable. Anyone can, instead of saving money, he will put 20%, which is nothing for normal expats or anyone living in Dubai. So he will put only 20%, and let's say for 40,000 US dollar as a down payment, and monthly he will pay $7,000, and that's it. Okay, he will start like a saving plan for himself. At completion, he will get a studio, like a saving plan. So you will not generate, because there is a high demand for people to buy studios for the purpose of prepare themselves for the retirement and having assets like a saving scheme. As for the let's say one floor for a small project, you can go and buy one floor and negotiate a better deal with the developers, and get, let's say, a discounted price. This is a good plan. Some investors I know, they bought the full building before it's announced to be constructed and everything, and agreed with the developer to be sold out to the end users through the developers directly, but they already invested in the full building. So it depends. One from Africa investor, he bought a cluster of villas, and it cost him 1 billion dirhams. Okay, it's around, let me calculate it. It's around $272 million dollars. So it depends. Okay, the more, the better. The more investment you put, okay, the higher income you will get, and the low competition you will face within the market. The normal people here, mostly they are doing real estate investment, and this is like a side saving plan for everyone.
Khaled, do you ever run into a situation where once a project is started, you said maybe 3 years to completion,
Yeah.
has there ever been a need for additional funds to be added for something that may have gone wrong, or something, that
Yeah.
you have to?
Yes. For sure, there is some developers, they face those issues, but those developers are not the let's say the top developers here in Dubai. Yes, there is a couple of developers in the past. They faced an issue financing, okay, during construction. The idea here, the investors are covered because the government monitor those funds for the under construction projects. All the funds for the under construction projects will go to the government escrow account for the project, and the government only release the fund upon a completion level. So if let's say the developer when he stopped doing the construction or start to delay or something, the government will take over the project, because they have the fund, and they will announce that another developer will take this position and will continue the project.
Okay, but it's mostly on the developer to come up with those additional funds going to the government, or is it on the investor who initiated the project?
The developer, he need to do, let's say, the announcement of the project, and he need to at least has 20% value cash money ready, plus the land. So before he registered the project, he need to own the land and has 20% cash to start the construction work. Then he can register the project within the government, and the government will accept to register the project and give the developer escrow account to put the fund there and to start the marketing for his project. They will give him a permit. You can announce that you have a project now, and you can accept payments from investors or end users, would say, not investors, okay, and start collecting money and put into the escrow account.
Gotcha.
What is cost per square foot for construction in Dubai?
It's now around 400. Let me calculate it. It depends on the location, and depends on the deal. So I would say it's around now $400 per square foot. And it's in other areas it's double this number. Depends if it's seaside or in the city side, the location, it's a villa or it's an apartment, it's commercial or residential. Okay, but the average, it's very low comparing to any worldwide luxury residential or luxury locations. It's very attractive, and it's every year this number is going up. But by the way, I made a deal yesterday. I got a better price. It was around $270 per square feet for an off-plan unit under construction for 3 years. And it's better than the current even prices. It depends on the negotiation also and your relation with the developers and how you can seal the deal and take the opportunity.
So when that's complete, when that unit complex, say it's a 50 unit complex, is that kind of average for development, or is it larger stuff that you're seeing more?
I didn't get it.
So like, how many units are people going after more frequently? Is it like 50 unit complexes, or is that more larger level?
Here, what we this buildings, okay, and apartments. This is the normal, what people are investing. There is also, they call it clusters here, okay, clusters, let's say of 200 villas or townhouses. Those clusters, okay, within they call it a community base. So I'm a developer, let's say. I announced there is a community will be built near the new airport, and this community will announce that the first cluster it has 200 units of villas and townhouses, each one between 3 to 4 bedrooms. Okay, and then I will announce to sell for the market. After finishing this phase, or this phase is sold out, I will start another phase, let's say another 300, 400 within the same cluster. This cluster has many amenities. Let's say there is gym, there is a school inside, there's some clusters, there's a hospital as well, there's a market center, of many things. Okay, so this is the normal how developers are doing here, either buildings or communities, I would say.
Oh, interesting stuff. What's the
By the way, they started now something, and I'm not sure if you have the branded buildings and branded cities. So we have now recently they announced the Mercedes-Benz city, okay, within Dubai, and it has many towers inside, and it's branded by Mercedes, and people are and they like the idea of investing with the branded apartments.
So what was your question, Alden? You were going to
Go ahead.
What kind of opportunities do you have? One that maybe you could just talk about. What's the potential? How much capital is needed? And what's projected return on investment?
It depends on the capital. As we said, if we increase the capital,
So say
can-
someone had $5 million.
well, if it's 5 million, we'll go for a small investment with a villa, and we'll go for off-plan project. And the off-plan project at least will give us 10% yearly capital appreciation for 3 years. So we will secure, I would say, 30 minimum percent capital appreciation once it's ready.
So
And
that,
you will pay the 5 million not in advanced. You will divide those 5 millions in 3 years.
so that's the building of a single family villa. One villa?
Yes, exactly.
So say someone had $50 million and they were wanting to do apartment development, what could that get them and what does that look like?
No, if we consider this as 30% for an individual, okay, you cannot multiply, let's say, for 50 or 60. You need then to negotiate more with the developer. They call it a bulk deal. So you will get better deal, okay, and you can get more than 50% till completion. So bulk deals, there's a separate negotiation before even the launch date of the project, and there is a high opportunities for a good capital appreciation within the bulk deals.
And with $50 million, someone wanting to get in on developing an apartment complex, maybe that's one complex. How many units is that, developed to 50 million, and what's a potential return on investment upon exiting the now performing apartment complex from development?
Well, it depends on the land itself, okay? Because there is lands you can build up to 30 floors. There is lands you can build up to 50 and more than 50 floors. So it depends on the land itself. It depends on the developer you will invest with, and it's not only the capital as much as the project, the developer, the land, the location of the land. All those matters to give you a good return on investment. The idea will sit you with a couple of opportunities. Okay, if you have 50 million, say, said Khalid, and I set a nice project for one investor, we will arrange a private meeting directly with the CEO of the development companies and the top development company, and we'll offer and see the opportunities they have, because they know many lands and they have a plans. They will start give you their options. Okay, if you invest, we can start with this one. This is the opportunity we have here. Now it's my turn to give you the advice of the location from my experience. The advice, if that location is good for apartments, it's not good for apartments, it's good for, let's say, because they will also, they have their own vision, but because I am your consultant, I will be guide you on if those key factors that I'm always focus on are achieved, because each developer will try to sell the investor his units or his project or that location or this location, but you need to negotiate and grab the best deal.
So here's where my head's at, as someone that has a fund, I look for opportunity. And what do people look for in 3 to 5 year Delta programs? They're looking for either like a 6 to 9% return pref and a 2x equity multiple over 3 to 5 years. It comes out to like 20% a year upon exiting a pro forma asset that's been developed. So throughout that time, they're making, say, 7 or 8%. Like, it'd be nicer to get lower, but that's attractive to capital investors. So throughout the construction and development, we're paying them 7%, and then they participate in the equity multiple of what our cost to what the property's value is, equating to potentially a 20% return on investment for the investor's capital. So for us to leverage our investors, that's kind of the boxes that those returns have to meet, if that makes sense. And if there are opportunities like that, it sounds like there may be, I'd be interested in exploring those further.
Good. Let's arrange to privately have a meeting and discuss opportunities here and see how it goes.
Happy to do it.
Okay.
Yeah. By the way, many investors did the first example you mentioned about the $5 million. And I have many private investors outside Dubai, and they like the idea, and because villas here, there is a lack of villas in Dubai in general, standalone villas. So they like the idea, and they invested in villas. Only one villa. We said, okay, I'll get one villa in Dubai. Okay, and worst case scenario, I will live and move and enjoy my life in this villa. But they accepted to buy as a start investments. Their started investment here and is $5 million in a villa, and this will be paid over 3 to 4 years directly to the developer, and they are very happy for their investments.
Okay. For somebody who wants to invest in a property and actually live in a small property, what's the smallest property somebody could invest in?
But as we said, the studio, it's like a hotel apartment. Okay, and we can say about 250,000 US dollars. And you will get something good, I would say. But I got one studio last month in a prime location in Dubai, in Business Bay, ready for 1,200,000 dirhams, which is around 1 minute. Which is around 325,000 US dollar. A studio, it's spacious, but in a prime location in Dubai, and there is a high demand for rental in that location. Purely, I got it for the side income for myself. 325,000 US dollar.
And I think in a previous conversation, I think $500,000 investment will enable someone to get a residency status and maybe even
a golden visa, 550, around 550. You are right. 550, you will get a golden visa. They call it golden visa, and this will allow you to come and enjoy anytime without any hassles or something. Open bank account and do multiple stuff. And this is actually, it's not for the US or Canadian citizens, because some countries they are not allowed to come to Dubai. There's some countries they are not allowed freely to come if they are not showing their position as investors or as a real, because they are trying to maintain a certain level of people to invest actually, and that's why mainly it attracts many people to buy property and to have this golden visa. Then they can also do multiple things, because the golden visa will allow you to bring your family. You will give it to your wife, you will give it to your kids. Okay, you will start a new life. They will join a schools. Okay, so any country facing issues, let's say war or something like that, and he has a property in Dubai and has a golden visa, can immediately move to Dubai next day and have a new life and have their he will secure his family, he will secure, because if any situation is happening in the Middle East especially, okay, next day, let's say, like an example, what happened in Syria, next day, if there is a war or something in Syria, the next day most of the countries will not allow the Syrian nationality to enter their country. So if you have the plan B ready by investing in Dubai, you already have the approval to come anytime, okay, because you are having the residency. So it's also a plan B for many, many countries.
Okay. So if we need to escape, we know where to go now. So.
Yeah, be ready. Because you are in Canada, okay? You never know what will happen.
Well, you never know, and we're living in interesting times here in North America.
Yes.
So, anyway, this has been great. What do you suggest for a discussion for next week? What would be a good thing to further our conversation here?
I think Aldrin asked for a couple of prices per square feet, something like that. I'll prepare something for the average prices, the apartment prices, and some areas now good for investments. And I'll prepare for you something about Dubai.
Yeah,
that might be interesting.
I was thinking of a broad topic, like maybe due diligence or something along those lines. Maybe we can invite Desi and Patrick or somebody to come from the Note Investor University, since we brought them up a few times today. Any
Yes.
ideas? What
I think that works. Due diligence kind of ties into, what you're paying for and what what the return on investment could be and why it's an opportunity and where to watch out. At the end of the day, those could all be great, topics of discussion, I think, to provide value that people watch this.
Great.
Okay, because in a way, the due diligence in Dubai is different because the escrow and the government organization, which is a bit different than in North America.
Yeah, I'll cover this part.
Yeah.
From my side.
Yeah. Okay. Well, let's do that, and we'll continue the conversation next Saturday.
Thanks for having me.
Okay. Thank you. Thanks for coming, and
That's
Rodney.
great.
Rodney's
Thanks,
always,
Rodney.
always great.
Thanks, Aldrin. Thanks, everyone.
All
Okay.
right. Take care.
Take care. Have a nice day, everyone.
Happy Saturday.